about 8,000 checks a year, which is through the accounts payable process. That's when you have your requisitions, your invoices. Those get approved through that process. And then we're just the ones that print the checks, but then we got to follow up on the outstanding checks. We do the bank reconciliations and those types of things. There are 400 different revenue lines, different categories of revenue that are receipted in the county. So we've got to make sure things are getting categorized correctly. And those go into about 60 different funds that the county has. And so things from road and bridge to 911, general revenue, those types of things. There's actually 60 of those funds out there. Some of them are a lot smaller, but those are what we manage. And then we manage the, let's see, we got that going. Let me see if this is up and running yet. There we go. Yay, all right. All right, so here we go. We'll get this caught up to me, and there we go. So the cash under our management right now is about $150 million. This is a little bit inflated from the usual because we're dealing with that COVID stimulus money. So we're still sitting on about $50 million of the COVID stimulus money. So that will go down. But the collector has been collecting revenue here. And on the 15th, if you're on time, Alan, we'll be adding maybe another 25 million or so to that 150 that's under our control. So we manage that in a portfolio that has about 200 items in it. That's everything from checking accounts to like an investment cash pool to individual investments like certificates of deposit and U.S. Treasury bonds and so forth. So we'll talk about how that 200 items in that portfolio of $150 million is managed. And we do that with a staff of 3 people. The sensor for that is on the other side of the computer, unfortunately. So there's no, you may just have to push the next button for me. Can you do that and just advance the screen for me? You're not having any luck either. Well, here, I'll look at my notes and see where the next thing we're going to. Our department is a revenue producing, there we go, department, which means we actually produce more revenue than it costs to operate. There you see our expenditures there, a couple $100,000 to run our office, mostly in salaries. And the revenues fluctuate quite a bit for our department. This is based on the current interest rates that are out there in the market. So you'll see last year, we only brought in 900,000 countywide. This year, this is 2.8, actually going to be closer to 2.5, but hopefully next year it'll be 3 million or more because interest rates are up. And so that is, so we can bring in that much revenue compared to the 200 or so thousand dollars that it costs to run the office. And the way that we bring in that revenue is through fixed income investing, right? So we're putting that money to work, that $150 million that's under our control. We're putting that to work to do some good for the county, to kind of do our share in bringing in revenues to operate things. Fixed income investing is basically not the stock market, not Bitcoin. It's not anything that's speculative or anything that's going to fluctuate in value a lot. It's when you have a guaranteed rate of return for a duration at a stated maturity. Most people are familiar with bank CDs. That's the way certificates of deposit work. You tie up that money for a year, and they say, we'll give you 3%. For a year for you to keep that money at our financial institution. So that's most of the investments that we have work that way. And we'll show you what those things are invested in here in a little bit. This is a picture of my office there on the left. I had the coolest office in the county until they built the new jail. And if you didn't get to check out Sheriff Arnott's new office, you need to check it out because he now has the coolest office in the county. But I am in second place There's a door to my vault. There's me guarding the money there out front. And if you walk into my office on the shelf, I've got a book there called Public Investing for Dummies. Now, I have not read the book. It's a little over my head, but I'm going to try and keep the cookies on the bottom shelf this morning as we explain to you what we're doing with the money. That book that I haven't read goes right along with the clock that doesn't work and the treasure chest that doesn't have anything in it. All right. Diversification. If you have ever heard about investing, and even if you don't know anything about investing, you've heard that you're supposed to diversify the portfolio, right? So these are the different things that the money is invested in. The largest, that red section there, 47%, those are U.S. Treasuries. Those work a little bit like the bank CDs that we talked about. There's a stated rate of return for a certain maturity date. When you put your money in, there's a few more options in there than you have with the certificates of deposit. But basically, instead of loaning your money to the bank, you're loaning your money to the federal government, U.S. bonds, right? So there's most of our portfolio there. Also, the U.S. government agencies are very similar to that. Those are things like the Federal Farm Credit Bank, Federal Home Loan Bank, those types of things, divisions or arms of the federal government. You see the certificate of deposit up there in green at 8%. Collateralized deposits, that's basically the checking account, but the reason the reason we say it's collateralized is because if you go in to the bank and you make a deposit at your local bank, you'll see a little plaque there on the front counter at the bank, and it says FDIC insured up to $250,000. Now, for most of us, for me personally, that is more than enough to cover all of my deposits that are going to be at the bank personally. But when you start getting into institutional size money, that $150 million that we've got, we need a little bit more protection than the 250,000. So we mandate that the banks pledge collateral that says if the bank fails, we get these assets. And those assets could be the securities like the U.S. Treasury bonds or other things, other assets that the bank has. They pledge those. It says if the bank fails, Greene County, these are set aside for Greene County. So our deposits are collateralized. And then we also have in that light blue section there that insured cash sweep. That works a little bit like your money market account that you might have at the bank. It pays a little bit higher interest rate than your checking account, but it'll take you 1 or 2 days to get to that money. And you can't write checks on it. It sits in a pool, and you have to transfer it into your checking account when you need it. It's a kind of a neat deal because the bank takes that deposit, that large deposit, say there's about $25 million in there, and they break it up into $250,000 chunks, and they move it to 80 different banks that also have the exact same program. And so they trade those deposits. So on paper, we've got 80 different deposits at $250,000 a piece, and it's all collateralized, or it's all FDIC insured. But practically for me managing it, it's just one pool. It's just one deposit with one bank that does all the heavy lifting for us. So it's been a neat little deal, and we'll show you later how that's been performing if we've got time. This is what's called an interest rate yield curve. This is what I'm watching all the time. And this is back in January of this year. We had, if you were to put your money out there and invest in the fixed income market for 6 months or 1 month, 3 months, you wouldn't hardly get any interest at all earlier this year. You go out about 2 years and you're at about 1%. You go out 5 years with your money, you're getting in the 1.5% range. This is what a typical yield curve the way it would work and the way you would expect it to work. The longer I tie up my money, the more interest, the higher interest rate I'm going to get. This is the way the yield curve looks right now. Interest rates have skyrocketed this year, and so this is December right now. And right now, the high point of the rate market is about 9 months. If I tie up my money for 9 months right now, I can buy an investment for almost 4.5%. And if I tie up my money for longer, the interest rate starts going down. And why is that? Well, because right now at a higher interest rate than what is considered normal or average, the thought is that the market is predicting that interest rates are going to go down from here. Now, right now it's predicted in the short term, it might go up just a little bit more before it comes down. And so this yield curve is what you call an inverted yield curve, where it doesn't go up like you would think. It actually goes down with time. And the reason that is because if you say, well, I just want to get the most interest I can for my money, so I'm going to put all my money in the 9-month investment. And when it matures, if interest rates are down at that time and you couldn't lock in anything at that high rate, say everything's around 2.5%, 3%, 9 months or a year from now, and you wouldn't be able to take advantage of the 3.75 for 5 years. So there's still a lot of strategy that goes along with investing, even in a yield curve like this. You just can't put all your money wherever the highest rate is at any given point. All right, so this is the way that we were performing on that yield curve. Remember, back in January, interest rates were pretty much zero, and the whole portfolio as a whole, interest rates have been low for a very, very long time. So if you take all the checking accounts and all the investments and you put all the cash together, it was earning an average of 0.61%. And by now, in December, a year later, we're at 2.5% yield for the entire thing. Now, you might be thinking, well, you just showed us a chart that shows interest rates are up in the 3 and 4% range. Why aren't we there yet? Well, some of those investments that we have been invested for a long time, and we locked in rates at 0.5%, at 1%, back when interest rates were lower. And you think, well, that was really dumb. Well, if I had had a crystal ball, then it would have been really dumb. But the market commentary here in just the last few days shows that this last increase from the Fed that has raised the rate a total this year of 425 basis points. That's the way us investors would say 4.25%. Okay, a basis point is 1/100%. And so that is a far cry from the 100 basis points, or the 1%, the increase that analysts were predicting earlier this year. So the whole market, everybody thought that interest rates, yeah, they're going to go up, but they're going to go up slowly. And that didn't happen. So now all of a sudden, everybody's upside down on their portfolio because they do have some items in the portfolio that are locked in at some lower rates. But there is some good news. We use an investment strategy called laddering. So that is, you think about your investments on a ladder. If you had a whole bunch of money to invest, you wouldn't put it all in one bucket. You wouldn't put it all into one investment. What I might advise you to do is put some of that money out for 5 years, 4 years, 3 years, 2 years, 1 year. And that way, all the time you've got money maturing. And then you roll that investment out at the top of that ladder, and then it shifts down with another year. You got more maturities, and you put that back out there. And that does two things. That always has money coming in case things get tight. It provides income, but then it also spreads out that risk. It causes you to have some always to be getting into the market at different rates, so that you're always getting the average rate. You don't get all stuck in one rate if interest rates go way up or way down. And so we use that strategy. And so that's why there is a 2.5% yield when the market all of a sudden jumped to 4%. So some people don't like to think of it as ladders. They rather think of it as buckets. So you don't have all your eggs in one basket or in one bucket. So we've got about 25% of the portfolio is liquid. That means it's ready to be spent. It's sitting in the checking account, or it's sitting in that pool, that cash pool that can be moved to the checking account. It doesn't have a specific maturity date tied to it. We can get to it. There's about 25%. This is a good bucket to be in right now, because as soon as interest rates rise, the rate on this bucket rises. The checking account's paying about 3%. That investment pool, or that cash pool, is in the 4% or more range. So it's a really good bucket to have a lot of our money in right now. Then the next bucket is where most of the money is. This is where 45% of the money is investments that mature between next month and a year from now, between 1 and 12 months. And this is another good bucket to be in because interest rates are high and they're still going up. So over the next 12 months, 45% of our money is going to be coming available to us, and we can move to those higher rates. So that 2.5% will rise very quickly because we've got 45% maturing in the next year. And then we have the long-term bucket, that 2 to 5 year bucket, where 30% of the money is. And this is kind of you would think of as a safety net when you're diversifying your portfolio, because if the bottom drops out and interest rates go way down unexpectedly, you've got rates that are locked in for the next 2 to 5 years that you've invested in that will continue to earn those rates regardless of what happens in the market. So with all this going on in the market, with these interest rates going sky high within 1 year from 0 to 4.25, how does that change your investment strategy? Well, here's one of the things that we've done recently is we withdrew certificates of deposit early. Now, I'm a rule follower, all right? And so if you've ever invested in a CD, you know what the rule is, right? You put your money in there and they tell you what the maturity rate, and the idea is that there's a penalty if you get to it early. So if you try and get your money early, you get penalized for it. So the rule is you never withdraw a CD early, right? Unless it's a real big emergency. Well, this was a hard hurdle for me to get over. But we went to the portfolio and we started looking at those penalties. The penalty is based on the current interest rate that the CD is paying. It might be 6 months of interest, 12 months of interest. Well, if you're only making 0.5% or 1% on that CD, that penalty isn't very high. And when you think about what you're losing, because the money is locked in at 0.5% or 1%, and you could be making 4.25, well, then all of a sudden you think, well, maybe it's worth it to take the penalty, get to the money early, and reinvest at the higher rate. So we did the analysis. Total investments that we flipped, we found that $4.8 million in the portfolio would benefit from a flip, from an early withdrawal and reinvest at the higher rates. So what does this look like? Well, I call up the bank and I say, hey, this is Justin, the county treasurer. Oh, hi, Mr. Hill. It's great to talk to you. Yeah, we've got a CD at your bank, and right now you're paying us 0.5% on that CD. I've done the math on the contract we have. It's only going to cost me a $5,000 penalty to take my money out early. And I can make $30,000 over the next 2 years extra by taking that money out early and reinvesting it. How does that sound? And they said, well, we love to have the county's money here at our financial institution. So let me go talk to my boss and see what we can do. And so they come back and they say, how does raising it from 0.5% to 3.75 sound? And I say, that sounds real good. And so others of them, they come back and they say, well, Mr. Hill, we can't waive the fee. Our computer system won't let us do that, but we're running a special right now. We got 18-month CD at 4.25. How does that sound? I said, that sounds real good. Some of them don't work with us at all. Some of them just say, yeah, our rates stink right now and we can't waive the penalty. I say, okay, take the money out, take the penalty, and go put it somewhere where it's making more money. So we flipped a total of 15 items, $4.5 million, and it cost us $36,000 in penalties and fees to withdraw that money early. Over the next 2 years, the premium or the additional interest that we'll make off of those investments over and above what they would have made, $286,000. So we made $250,000 just by making some phone calls, redoing some paperwork, and flipping those CDs. Some people flip houses. Here at the county, we flip investments. That doesn't happen very often. This is the first time that anything like this has ever been possible or been beneficial for the county because interest rates have just gone so high so fast. Usually that doesn't work. But I tell you that for your own personal benefit. You might have certificates of deposit. You might manage some certificates of deposit for maybe an aging family member or something like that, that you're managing their money. you might want to go back and look at those. If they don't mature for a year or more and they're at a very low interest rate, you might benefit from flipping those or going to the bank and asking them to bump the rate. And if you need help with those calculations, let me know. Here's something else. The market value. How am I doing on time? 6.5 minutes left. All right. Here's something else that's very interesting, and we'll probably end with this, is that the market value of the fixed income investments that we hold. This is something that most people don't think about because they think of fixed income investing as, well, I get, the rate of return, the interest rate is stated at the beginning. So we know exactly what it's worth. Well, if interest rates go higher or lower, the value of that investment fluctuates. And let me explain how that works. In this is a trade ticket that I did. I don't know if you can read that from there, but this is a treasury. And this don't work on that screen. So back in the bottom left corner, you'll see this is a U.S. Treasury bond, and it has a coupon rate. That's the interest rate that it's paying at 2.625%. That was a good rate a little while ago, earlier this year. That would have been a great bond to be holding in your portfolio. Now, not so much. And the poor sap that was holding on to this investment had to sell it early. And so they sell it on the market. These things are traded, brokers, they fixed income traders, they do this all the time because people are constantly moving money around in institutional investing. So this person is holding on to this investment at 2.6%. Well, the market's paying 4.25% right now. So does anybody want to buy this bond paying 2.6%? No, not at full price anyway. So what they have to do in order to unload this, this up there, it says par amount basis $800,000. This is $800,000 worth of this bond. At 2.6%, nobody wanted to buy it. I bought it at, you see the principal amount down there in the bottom right-hand corner, $792,000. We bought $800,000 worth of maturity value. It matures in 7 months, and we bought it for $792,000. So that means we make the 2.6% on $800,000, and when it matures, we get our $800,000, and we got all that for $792,000, which gives us the effective yield of the market rate at 4.25%, 4.252. So I show you this so that you understand that the items in the portfolio now, we don't want to be selling them, because then we would have to be the guy that's taking an $8,000 bath when we sell our the investments. We'd have to be taking a loss on those. But it's also helpful for you to understand, because a lot of you have a well, not a 401k, but the 457, right? Your government retirement plan. And hopefully some of you are able to take advantage of a SURF deal where you have up to 6% of your paycheck withheld and matched 50 cents on the dollar going into your investment account. If you put that in a conservative profile, you're investing in things like these, in funds that invest in things like these bonds. Now, you may be wondering why earlier in the year, if I'm in a safe investment, if I'm in a conservative investment with a bond, that investing in bonds and interest rates go up, how come all of a sudden it says that the value of my portfolio, the value of my retirement went down? This is a temporary market adjustment. And the reason is this here: if that investment manager had to go sell investments right now to pay you off because you wanted to pull your money out of that fund, they would have to go and sell an investment, an $800,000 investment, maybe for $792,000. There's a market adjustment. And so the value of your retirement is tied to what those investments are worth if they were to be sold today. The trick is that when the investment temporarily goes down, whether you're in the stock market or in the bond market, you don't pull your money out because on paper it says that you lost that money. those investments will continue to make the 2.65% until they mature. And when they mature, they'll get reinvested at higher rates. And that will cause the value of that fund that you're invested in to go up. And eventually, that retirement that you fund that you're watching every day and getting stressed over when it goes down, it will come back up with those higher rates. You just have to be patient. But I thought that would be valuable to show you because that's some of the things that we deal with in our office. And it's also something that affects you personally with your retirement. So hopefully that's a little something that you can take with you and that you understand that a little bit better as you go forth for today. I think we're out of time. We got 60 seconds. Does anybody have a question?
Those different categories, Justin, you were talking about the 3 different categories.
The buckets? Yeah.
Do you ladder each of those?
Oh, yeah. So each of those buckets, that's me consolidating the ladder and showing you the ladder in the ladder slide that you saw, you think of that 3, 4, and 5 year rung on the ladder is all in that last bucket, the 2 to 5 year bucket that's invested for that long. So yeah, it's just showing you the ladder in a different, really the way our ladder works is we don't have money like all our money coming due in January of 2023. We've got investments rolling off that portfolio every couple of weeks. So in a month, we'll have $6 or $7 million roll off of that portfolio that get reinvested at those higher rates. That's what our ladder looks like. Every couple of weeks, we've got something, and that ladder goes all the way. Like I said, there's 200 items in that portfolio, so it's a big ladder. You wouldn't want to climb it all. It would be if you're afraid of heights. Good question. Anything else?
Justin, who makes all of the investment decisions?
I do. And that's why I report to you. And sometimes I go to the commission and say, hey, I'm just going to make an investment report so that anybody that wants to ask the questions and kick the tires and say, hey, Justin, have you thought of this? Are you doing this? Is the money safe? What are you doing? You're welcome. We're all on the same team. You're welcome to ask me anytime or to bring ideas to me at any time because, I've got brokers I work with. I've got other county treasurers I can consult with. But if I'm going to go out and buy that investment that I talked about, buying that $800,000 investment for $792,000, I thought that was a good deal. I bought it, but I didn't consult with anybody first. So I do make those sole decisions. I'm authorized to do that.
You seem brilliant. I'm glad you're in control.
Well, thank you very much. I appreciate it. And hope you've learned something. And thank you so much for coming this morning, day after a holiday. It's really nice that you make the effort to come and attend this morning. So thank you.